Hi everyone, welcome to lesson 52 of Excel course. Today we are going to see financial functions. Excel's financial functions are not only popular with finance and accounting professionals, but also with many other people such as students, investors, borrowers, etc. These specialized functions are useful for calculating many financial values such as payments, interest, and investment values over time. In this lesson, we'll have an overview of some of the commonly used financial functions. Remember that in this lesson, all numerical values in the examples are formatted as numbers instead of specific currency to make understanding easier for students from different countries. So in this lesson, we'll learn the following financial functions: FV, that is future value function; PV, present value function; PMT, that is payment function; IMPT, interest payment function; PPMT, principal payment function; NPER, that is number of periods function; IRR, internal rate of return function; and NPV, net present value function. And finally, we'll see assignment 52-1. Now let's look at the PV function, that is the future value function. The description of this function is: this function calculates the future value of an investment based on constant interest rate. It can be used with either periodic constant payments or a single lump sum payment. The syntax for this function is equal to FV, then rate, NPER, and PMT. 3 arguments are required, and other 2 arguments, PV and type, are optional. So let's look at these arguments. These arguments are very important to understand because other functions such as PV, PMT, IPMT, etc., what we are going to see in the next topic, also use the same or similar arguments. So if we understand the arguments in this topic, it will be easier to understand other functions. So let's see the arguments. The first argument is rate, which is required, and this is the interest rate per period. It is important to be specific about the period here. So if the interest rate is 10% and payments are made annually, then the rate should be 10% or 0.10. But if the interest rate is 10% and payments are made monthly, then the rate should be 10% divided by 12 or 0.10 divided by 12 because the payments are being made monthly. The next argument is NPER, that is also required argument, which indicates the number of periods from now for which we want to calculate the future value. The periods for this argument should be same as those used in the rate argument. So whatever period we are using here should be used here also. Then PMT is also required argument. This is the payments made each period. If PMT is omitted, then the PV argument is required. So PV argument is required if PMT is omitted. And PMT means it is the payments made each period. For example, if we invest 100 a month for 10 years, the PMT should be 100 and the NPER, that is number of period value, should be 120, that is 12 months times 10 years. Then next argument is PV, that is optional argument. This is the present value of the investment. If PV is omitted, it is assumed to be 0 and the PMT argument is required. So if we don't give PMT, then if we don't give PV, then we have to give PMT and vice versa. So PV argument is used to determine the future value of one-time lump sum investment. We can also use this argument in addition to the PMT argument to determine the future value of an investment in which we already have money but plan to add money periodically. Then the last argument is the type argument. This is also optional. This argument takes the number 0 or 1 and indicates when the payments are due. If omitted, it is assumed to be 0. So 0 means if payments are due at the end of period, or if it is 1 means if payments are due at the beginning of the period. Then other thing we need to understand is we need to use positive numbers for inflows, that is any amounts we receive, and negative numbers for outflows, that is any amounts that we pay. We can also use FV function to calculate the future value of lump sum investment. For example, if we put 1000 in a fixed rate investment and do not make periodic contributions, we enter 1000 in the PV argument and do not enter the PMT argument. The FE function would return the future value of that lump sum investment. So now let's see some examples here. So let's take example 1 here. Find the future value of an investment if an investor puts 1000 into an investment with an annual fixed rate of return of 8%. The investor plans to contribute another 500 each month for 30 years with payments made at the end of each period. So we have a table here and we'll start putting the values. So rate of interest is 8%. Then number of period. So this NPER, here we need to be careful. Number of periods is, here it's mentioned 30 years, but it is for each month. Payment is for each month. So we'll have to put 30 times 12. So we get NPER as 360 months. Then payment. Payment is 500 for each month. So we'll put 500. But remember, 500 is going out from us. So it will be minus 500. Then just a minute, so minus 500. Then we have present value. So we already put 1000 into an investment, so we'll say minus 1000 was already put. And payment type. Now payment is made at the end of each month. So if payment is made at the end of each month, it is 0. So we get 0. Now let's enter the function here equal to FV, that is future value function. Okay. And then let's just move this. Here it's easy to understand. So FV, we have got rate. Rate is 8%. But we need to be careful because this is 8% annual interest rate. Okay, we are making payments per month, so we need to divide by 12. Okay. Then NPER is 360, which is already in months. Then PMT is minus 500, PV is minus 1000, and type is end of each month. End of each month is 0, which we already put it here. So we can close the parenthesis and press enter, and we get the future value as 756,115.45. Now let's take another example where the investor puts 1000 into an investment with annual fixed rate of 8% for 30 years, and the investor does not plan to contribute any amount in future. Okay. So here also let's directly calculate. We'll put the function equal to FV, and we will have rate of 8%, and here we'll not divide by 12 because he is not putting any monthly payments. Okay. Then NPER is number of period is 30. Okay. PMT, he is not making any payments, so we can leave it blank. Then PV is minus 1000, he has already paid. Okay. And type, we can leave it blank because it's optional argument. So we'll close the parenthesis and enter. So at end of 30 years he will get 10,062. Now let's look at the PV function, the present value function. This function calculates the present value of a loan or an investment based on constant interest rate. The syntax for this is PV, then we have rate, NPER, PMT as required arguments, and PV and type are optional argument. So rate is the interest rate per period. NPER is total number of periods in an annuity. Then PMT is required argument. It is the payments made each period that cannot change over life of annuity. FV is an optional argument. This is the future value or the cash balance to be attained after the last payment is made. If FV is omitted, it is assumed to be 0. Then type argument is an optional argument. This is number 0 or 1 and indicates when payments are due. If omitted, it is assumed to be 0. 0 means if the payments are due at the end of period, and 1 means if the payments are due at the beginning of period. Now we need to again remember to use positive numbers for cash inflows and negative numbers for cash outflows. So let's look at the example. An investor plans to contribute 500 each month for 30 years with the payments made at the end of each month and an annual fixed rate of 8%. So calculate the present value of the investment. So rate of interest here is 8%. Then NPER, again he is contributing for 30 years each month, so it will be equal to 30 times 12. Okay. Payments, he is making contribution of 500 each month, so that will be minus 500 because that's a cash outflow. Future value is 0 and payment type is also 0, or we can leave it blank. So we'll just put it there. So present value, the function is equal to PV and rate. Rate is 8%, and we need to divide this by 12 because of monthly payments. Then NPER is 360, that's already in months. Then contribution each month is minus 500, and then FV is 0, or we can just omit that and close the parenthesis and calculate. So we got the value of present value of 68,141.75. Now let's look at the PMT function. This function calculates the payments for a loan with a fixed interest rate and fixed payment periods. Some of the applications for these functions are to calculate payments for a fixed mortgage, or a home loan, or a vehicle loan, or student's study loan. The syntax for this function, PMT function, is rate, NPER, PV as required arguments, and FV and type are optional arguments. So like we saw in the last topic, rate is the interest rate for the loan, NPER is required argument, that is the total number of periods or payments for the loan. PV is also required argument, which is the present value. It is also known as the principal. Then FV is optional argument. This is the future value or cash balance to be attained after the last payment is made. If FV is omitted, it is assumed to be 0, that is the future value of loan is 0. Then type argument, that is also an optional argument. It indicates when payments are due. If it is 0, it is 0 if payments are due at the end of period, or it is 1 if payments are due at the beginning of period. If omitted, it is assumed to be 0. Now let's see an example for this. So here we need to find the monthly payments for a 5-year home loan for 10,000 with a fixed 9% interest rate. Payments are made at the beginning of period. Now remember, here is we need to find the monthly payments. Okay, so rate of interest is 9%. Then number of payments is for 5 years we want, so that will be equal to 5 years time 12 months, that is 60 months. Then we want a loan of 10,000, so we'll put 10,000, and it is the cash inflow, so we'll put it positive. Then future value, we have nothing, so we'll put 0 or omit it. And type also, it is made at the beginning of period. It is beginning of period, it is 1, so we'll have to put 1 here. Okay, so now let's enter our function, that is equal to, and we want PMT function, payment function. Okay, and here we want rate is 9%, but we need to divide this by 12 because the payments are monthly. Then we have NPER, that is 60, number of period is 60, which is already in months. PV is 10,000. Then future value of this loan is 0, and the payment is made at the beginning of period, that is 1. So we'll close the parenthesis and enter, and here we need to pay 206.04 per month for 5 years for this home loan. Now we'll see IPMT function. See, in the last topic we saw PMT function, which is a payment function. So for a loan, if we make a payment, it consists of two parts. One is the interest part, which is given by this IPMT function, and next we are going to see is PPMT function, which gives the principal part. So the total payment consists of interest plus principal. So let's see IPMT function. This function returns the interest payment for a particular payment of an investment or a loan with regular payments and fixed interest rate. The syntax is similar to all the functions what we saw earlier. So syntax is IPMT, then we have rate, PER, NPER and PV. So 4 are the required arguments. Then we have FV and type, which are optional arguments. So let's see each argument. Here is rate. Rate is required argument, and this is the interest rate per period. It is important to be specific about the payment period here. So which we already saw, if the interest rate is 10% and payments are made annually, then the rate should be 10% or 0.10. And if it is monthly payment, then we need to divide by 12. Then PER is also required, and this is the period for which we wish to calculate the interest. And this is a payment number, and this is important now. If payments are monthly on a 5-year investment, the PER value will be somewhere between 1 and 60, because 1 month and 60 months for 5-year period. Now suppose if you want to calculate interest for the first month of 3rd year, okay, the value will be 25, because for first year it is 12 months, again for second year it is another 12 months, meaning 24 months, and first month of the 3rd year means 24 plus 1 month, which is 25. Then NPER is also required argument. This is total number of payments for the investment. The periods for this argument should be same as those used in the rate argument. Then FV is optional argument. This is the future value of investment after all payments have been made. Okay. If a value is not entered for FV argument, it is treated as 0. For example, in case of a loan, we are interested in paying off a loan in full so that the final or future value is 0. Then we have type argument, which is optional. This is the number 0 or 1 and indicates when payments are due. If omitted, it is assumed to be 0. So it is 0 if payments are due at the end of period. It is 1 if the payments are due at the beginning of period. Also we need to remember to use positive numbers for inflows, that is any amounts received, and negative numbers for outflows, that is any paid amounts. So let's take an example here. Now we need to calculate how much interest a borrower would owe in the first month of the 3rd year. Okay, so we want to calculate in the first month of a 3rd year. Okay, for a 5-year 10,000 loan, if the rate of interest is 8% per annum and payments are due at the end of each month. Okay, so let's start putting the data here. Okay, rate of interest is 8%. Then we have period. Now period here is first month of 3rd year, means it is 25. Then number of payments, so it's a 5-year period, so number of payments is 5 years, means 5 times 60, sorry 5 times 12, that is 6. We have the present value of 10,000 loan we are taking, so it is positive 10,000. Okay. Future value will be 0 because we want to pay off the loan, and payment type is due at end of each month. End of each month means it is 0. So let's put our function here equal to IPMT, okay. And then we want rate of 8% divided by 12 because of monthly payments. Then PER is 25. Then we have NPER is 60. Then then we have PV is 10,000. Then we have FV 0, and period payment type is also 0. So we'll close the parenthesis, and here we got the value that we need to pay 43.14 for this loan per month. Now let's look at the PPMT function. In the last topic we saw IPMT function, which calculates the interest payment on a loan. Okay. Here we are going to see the principal payment. Okay. So the PPMT function returns the payment on principal for a given period of an investment or a loan based on regular payments and the fixed interest rate. The syntax for PPMT function is rate, PER, NPER, PV as required arguments, then FV and type are optional arguments. So rate is required argument, it means the rate, interest rate per period. PER is required argument, it is the period for which we wish to calculate the interest. NPER is required argument, that is the total number of payments for the investment. PV is also required argument, this is the principal or lump sum value. Then FV is optional argument, this is the future value of investment after all payments have been made. Type is an optional argument, it is 0 or 1. It is 0 if payments are due at the end of period, and 1 if payments are due at the beginning of period. Now if we add the values returned for the same period and the same loan by IPMT function and PPMT function, we can calculate the total payment for the period, which is given by our PMT function. So let's take an example here. Example is to calculate how much principal payment a borrower would owe in the first month of the third year of a 5-year 10,000 loan if the rate of interest is 8% per annum and payments are due at the end of each month. So here we have rate of 8%. Now period is first month of the third year, okay, which is 25. Then number of payment is 5-year period, so we'll have to put 5 times 12, that is 60 months. Then principal value, so we'll have to put 10,000 and with the positive sign because it's the cash inflow. Then future value is 0 and type is also 0 because payments are due at the end of month, so type will be 0. So let's calculate how much principal amount we need to pay for this loan is equal to PPMT. Okay. Rate is 8% divided by 12. Then PER is 25, NPER is 60, PV is 10,000. Okay. FV is 0, we can omit it or put as 0, and payment type is 0. So we got the value principal payment of 159 and 63, 159.63. Now let's look at the NPER function. This function returns the number of periods for an investment based on periodic constant payments and a constant interest rate. The syntax is NPER Then rate, PMT, PV are required arguments, FV and type are optional arguments. So the rate is the interest rate per period, PMT is the payment made each period that cannot change over the life of the annuity. Then PV is required argument, this is the present value of the investment. FV is an optional argument, this is the future value or cash balance to be attained after the last payment is made. If FV is omitted, it is assumed to be 0. Then the type argument, which is also an optional argument, this is either number 0 or 1. It is 0 indicates the payments are due at the end of period, and 1 if the payments are due at the beginning of the period. Then we need to remember to use positive numbers for inflows, that is any amounts received, and negative numbers for outflows, that is any amounts paid. Now let's take an example. The first example here, we need to calculate the number of periods for a car loan with an annual interest rate of 12%, a payment of 100 per month, and the loan amount of 10,000. Payments are made at the beginning of each period. So interest rate here it is 12%. Then we have payment made is 100, but because it's a payment, it's a cash outflow, we'll say minus 100. Then the present value is 0. Then future value, it's a loan of 10,000, so we'll put 10,000 here. And then the type, that is beginning of each period, so it will be 1. Now let's put the function equal to NPER, and the rate is 12%, but because it's a monthly payment, we'll have to divide by 12. Okay. Then payment made each month is 100. Then present value is 0. Sorry, here we need comma. Then present value is 0, comma, future value is 10,000, and type is 1. So if you close parenthesis and enter, we get number of periods is 69.16 months, or 69 months if we round it off. Now let's take another example. Here is to calculate number of periods for an investment with an annual interest rate of 12%, a payment of 100 per month with initial amount of 1000. In the first example, we did not have any initial amount. Here initial amount is 1000 and the future value of investment is 10,000. The payments are made at the beginning of payment period. So rate of interest is 12%. Then we have payment made each month is 100 with negative sign, it's a cash outflow. The present value is 1000, which is minus 1000 because this has been already paid. Okay. Then future value is 10,000 and the payment type is 1 because it is made at the beginning of each month. So we'll put our function here, NPER. We need to calculate number of period. NPER is, first is rate, which is 12%, but we'll have to divide by 12 because of monthly payments. Then we have payment each month, and then we have present value of minus 1000, which we already paid, and the future value of 10,000 and a payment type 1. So here the period number of months is 59.67 or 60 months. Now let's look at the IRR function. The internal rate of return, that is IRR, is the interest rate received for an investment consisting of payments and income that occur at regular periods. If it is payment, will indicate with negative values, and if it is income, the function will return the positive values. The description for this function is returns the internal rate of return for a series of cash flows. These cash flows do not have to be constant or same, but they must occur at regular intervals such as monthly or annually. The syntax for IRR function is we have values, which is required argument, and guess is an optional argument. So values is an array or reference to cells that contains numbers for which the internal rate of return needs to be calculated. And guess is optional. This is a number that we guess is close to the internal rate of return. If it is omitted, it is assumed to be 0.1, which is 10%. So let's take an example for this. Here we have a cash flow that has been recorded for 5 years, including the initial cost of business. So initial cost of business is 70,000, and because it's a cash outflow, it has been indicated as minus 70,000. Then we have the net income for first year, second year, third, fourth and fifth year. With we have cash flows, various cash flows. It is not constant. Okay. So we need to calculate the internal rate of return over first 3 years of business. So we'll say here equal to, we'll put function IRR, and we need values here. If we want only IRR for first 3 years of business, we'll give the array. This is the initial investment, first year, second year and third year. So that is the range of C9 to C12. Okay. And will not give any guess here. So default guess will be 10%. So we'll enter this value. So we got IRR is negative 18.2%. Now let's look at the NPV function, or the net present value function. This function calculates the net present value of an investment by using a discount rate and a series of future payments and income. The syntax is equal to NPV. We have rate, which is a rate of discount per period. It is the required argument. Then value 1 is a required argument, and subsequent values, value 2 to value 254, are optional arguments. Okay. And the value argument represents the payment and income. Now the cash flow or value argument period must be fixed. The payments or income must occur at end of each period. Other thing to notice is the NPV function does not take into account the initial cost of investment or the cash flow at time 0. Let's see an example of this. Here we need to calculate the net present value of a business with 70,000 as initial cost of business. The cash flows for first, second, third and fourth year are 60,000, 40,000, 30,000 and 25,000 respectively, and the discount rate is 9%. So we have discount rate of 9%, initial cost of business is minus 70,000, and then we have cash flow of 60,000, 40,000, 30,000 and 25,000. So we need to calculate NPV. So we'll start doing by putting equal to sign, NPV star parenthesis, and here we need to give rate. Rate is the discount rate, which is 9%, then comma. Now we need to put value 1, value 2, etc. We don't have to put initial cost of business because the function doesn't take that into consideration. So we have 60,000, 40,000, comma, 30,000, comma, 25,000. We close the parenthesis and we get the net present value of 129,589.21. Now we need to remember that the initial cost does not include in the function. The initial cost is not included in the function. To calculate true NPV of the investment, we must subtract the initial cost of investment from the value written by NPV formula. Hence the true NPV value is 129,589.21 as NPV function has written minus the 70,000 what we had invested as initial cost of business. So true value of NPV is 59,589.21. Now let's see assignment 52-1. Please note down the assignment and we'll continue with the solution after that.